Welcome back, everyone, to another episode of On the North Road. My name is Cary Williams, Director of Research and Portfolio Manager at North Road Investment Counsel. Today, I am flying solo, going to show you our mid-year review for 2026. This is the first 6 months of 2026. I'm going to actually talk about, I would say, two main things. One is an update, so that's going to be an update on North Road as well as what's happened in markets. And then the second piece of what I'm going to talk about is going to be understanding what's happening under the surface in markets, what's driving the really fantastic returns we've seen for the last few years, as well as what the risks might be, and finally, whether or not we should stay optimistic moving through 2026 and into 2027. Without further ado, then, I'm going to bring up my slides. Today's going to be a very visual presentation. So if you are listening in instead of watching, I would suggest that you try and find at some point a good size screen so that you can see the slides I'm talking about. I will try and talk through each of these, but it's going to be pretty quick. So, and pretty visual. So get yourself prepared. Here we go. 2026 mid-year review. First, to start with the North Road update, very excited to talk about two of our colleagues, Corey and Richard. Corey on the left, many of you have met Corey. Corey had a really great first few months of 2026, finished up Chartered Investment Manager designation, Certified Financial Planner designation, on his way to getting registration that we're working on right now to keep him moving forward in his career. So high five to Corey. Really great to have an educated, great colleague, another one on our staff. On the right side is Richard. Many of you won't know Richard. Richard is kind of a behind the scenes guy. He's the one looking at your portfolios every day to confirm that your asset allocation, how you own things, and how much of each piece of your portfolio is owned and whether or not it's on target. And so Richard is doing the heavy lifting as far as making sure that we're rebalancing portfolios and keeping you on task around your risk management. So high five to Richard. Richard did his Chartered Investment Manager designation, as well as passed his first Chartered Financial Analyst exam. So that's CFA 1. There are 3 exams in getting your CFA, and Richard is a third done and working on number 2. So great job, Richard. Really happy that you are able to keep that education going. One of the things that happened in the first half of 2026 is that for the second year, we went down to Mexico and presented to Canadians in Mexico. Last year, Marshall did a session in Puerto Vallarta, and then this year we expanded to Mazatlan and Punta Mita. This is really, really fun. On the left-hand side, you can see me presenting down in Mazatlan, and really great to connect to Canadians who are either retirees down there or spending winter down there as snowbirds. On the right side is a photo of Marshall, and for the first time this year, Marshall flew to the Middle East and did presentations on markets in the Middle East to Canadians there. So really exciting for us to be expanding who we're talking to and have a chance to take in some warm climates. In addition, in the early 2026 months of 2026, we launched North Road Waypoint on our website. Waypoint is where we're going to collect our writing for folks to review and be live on the web in perpetuity. So we put out our Quarter Mile, which is our brand new quarterly newsletter. This is a kind of mid-length write-up on a topic of interest that we think is valuable for clients to understand, a little more than kind of the headline, but not so much that it's an academic paper. So in June, we put out a little bit early our SpaceX IPO write-up that you may remember receiving, and we had great feedback on that. North Road Waypoint on our website is a place where you can go and you can find any of the old writings that we've done, and you can send them to colleagues, families, friends, anyone who you think might benefit could be directed there. We also received a couple of recognition moments over the last few months from publications. Edify Magazine recognized us as Trailblazer 2026. Really thankful for that. They looked at us as an independent firm here in Edmonton, as well as digital risk advice in our DRA program. So it was fantastic to meet everybody at Edify and be featured there and to be a part of their ceremony that they do for folks each year. In addition, Misha and I were featured in Canadian Family Offices magazine to talk about cybersecurity and digital risk advice. We weren't the only firm featured. It was a really great article about what it's like to be an investor in modern times and also to be running family offices in modern times with the cybersecurity situation the way it is. If you get a chance, I'd highly recommend you read it. All right, moving on to 2026 so far in markets. I'm going to spend a bunch of time looking at the core areas of markets that we're invested in and that clients are invested in. To start, let's look at the Canadian market, large companies versus small companies. We always like to focus in on separating out what's called market capitalization in indicating what's happening in markets. So market cap is one of the factors we look at. We like diversification. We like to own more than just the largest companies in any country. And that was rewarded both in the first 6 months of this year as well as the last few years here in Canada. This is not always a consistent factor that pays off in Canada. It tends to be a little more inconsistent than some of the other geographies that we invest in, but really great to see that we've been rewarded for holding smaller companies over the last few years here in Canada. I would say, without having the data here in front of me, that probably a good chunk of this outperformance has come from mining, gold, resources extraction, those kind of areas that Canada is a real leader in. In addition, looking at value versus growth. So as a reminder, value is generally, we consider this to be low prices on a stock against some sort of accounting metric. Accounting metric like book as an example, or sometimes we hear about price to earnings, things like that. Value has outperformed here in Canada over the last few years. Growth, being the opposite of that, has underperformed, especially in comparison to value here in Canada. In the US, we see a bit of a mixed bag here, a bit of a reversal actually in the last year compared to years prior. So large companies have higher 3-year returns. But if we look at so far this year, as well as the 1-year numbers, we see quite a bit of outperformance by smaller companies in the US in a very similar way to what we saw in Canada. In addition, very similar kind of split between that 3-year return and the 1 and 6-month return in value versus growth. So growth outperforming in the longer period, and then value outperforming in the more recent period by quite a big variance there. International, so large versus small and international. This is developed markets, so not emerging markets, just developed markets. Large outperforming small in all periods here, both year to date, 1 year, 3 year. Not as dramatic as some of the other geographies that we've looked at. Value also outperforming. So even though in the US, we've heard a lot about, up until the last kind of 6 to 12 months, a lot about the death of value investing because tech and growth investing has done so well in the US. Internationally, that hasn't really been the case. Internationally, we've seen a lot of outperformance from value over the years. And so interesting to see in the US that there was this reversal in the last 12 months where value has outperformed, and it'll be interesting to see if that continues. Emerging markets really quite a bit different than the other geographies. So emerging markets, large outperforming small. So unlike in Canada where we had outperformance in small companies, and then in growth versus value, growth outperforming by a couple of percentage points in almost all of the time frames that we're showing here. Last but not least, momentum. So we do believe in momentum as a factor. So instead of being tied to some sort of accounting metric, momentum traditionally, or at least in its simplest form, is thought of as just price movement. So in the short term or the recent history, has price gone up? It's likely to continue to go up within some caveats. And then if it's been going down, it's likely to continue to go down. So we can see here with Vanguard's Global Momentum Fund being exchange traded fund, being the kind of proxy for momentum that we're using. Really phenomenal returns in the first 6 months of the year, up 31%. Amazing returns for the 12-month period, up 49%, and unbelievable returns for the 3-year period, up 32%. So momentum at the end of June was our highest performing factor that we're looking at. That has reversed. I'm recording this July 28th, and that has actually reversed in this month. So in July, we've had a real underperformance of momentum after having this phenomenal performance up to the end of June. This can happen, especially in momentum. Momentum is known for being quite a strong performance, good returns factor until it's not. And then we see this reversal that can be quite painful. We haven't seen the pain, so to speak, so far in July. It's been pretty significant. I think minus 9 or 10 up to this point from July 1st to July 28th. But we'll see what happens moving forward. All right. I want to draw attention to some of the variance here in between different areas of the market. So this slide looks at US technology, Russell 1000 technology ICB index versus the Russell 1000 value. And it goes back to 2022 in the chart, even though it's got 3-year returns on the right side. And so the 3-year returns on the right side match what I've shown you already in some of the geographies. And then the chart goes back to 2022. And I think this is really valuable because 2022 saw pretty nasty returns. You can see here where I've put my red dot to highlight 2022. We've got the value index in blue and we've got the technology index in green. And we saw through 2022, if you remember, inflation was high, interest rates started to be pushed up pretty dramatically and quickly. And we saw tech companies really get hurt in that period as far as their stock prices. And then lo and behold, ChatGPT gets released, and we start to see that reversal and the takeoff that we've seen from technology and growth and momentum over the last kind of 3 years from that point. We can see here in green then that the gap between technology companies and value companies in the US has been pretty significant, even though there's been big bumps along the way for technology. Every time we see that there's been some sort of concern around what the underlying factors that could influence technology and growth investing, we see pretty big drops as the market tries to figure out how do we integrate this new information on artificial intelligence and its impact on the future of these businesses and figure out what they might be worth. All right, value versus growth outside the US, we can see it's the opposite story. In green, we've got all countries ex-US, so outside the US, that are value companies, and then all countries for the world ex-US that are growth companies in blue. And we can see that going back to 2022, consistent outperformance by value in all the countries outside of the US. So the opposite of what we've seen in the US. All right, Canada versus the US versus the globe. So just general indices here. We can see Canada in green actually outperformed in 2022. As might be expected because we're a little less tech focused. And then as the tech roars, we see Russell 3000 index in blue outperforming. And then a little bit of outperformance from Canada last year because of gold and some of those other things, oil, and I would expect any of that resource extraction with prices increasing in commodities, helping to pave the way for Canada. And then we can see the bounce here where in 2026, all geographies are pretty close actually. Okay, long-term versus short-term bonds, thinking about our fixed income, sort of our stabilizers in the portfolio, going back again to 2022 when interest rates started to rise. We can see this red line, which represents long-term Canadian bonds, being really, really hurt. It is one of the worst periods for long-term bonds that we have on in the historical data that's available. And you can see through 2022 and into about October 2023, a downturn here in prices. And we haven't even recovered from 2022 levels even to June 30th, 2026 in long-term bonds. So even though in the returns on the right side, we can see that year-to-date long-term bonds are up 3.4%, which is a nice return for the first half of the year in bonds. We can see the 3-year returns are 2.6 and significantly lower than short-term bonds and the overall Canadian universe, which is in yellow. So even though their last few months have outperformed, long-term bonds have outperformed short over the last 3 years, and especially back to 2022, short-term bonds have outperformed as a result of rising rates over that period. As you may remember, when interest rates rise, bond prices fall. And so that's what's happening there when interest rates rose in 2022. What's going to happen now? Well, I'm going to touch on inflation a little bit later on, but it's going to be interesting to see how the Bank of Canada and in the US, the Federal Reserve decides to approach inflation on interest rates moving forward. We know that that inflation has continued to be sticky, especially with the war in the Middle East. And so really challenging times around interest rates and what might happen there. All right, let's look at currency. So here I've got S&P 500 in Canadian dollars versus US dollars. So exact same investment in two different currencies. Think of the Canadian side being unhedged. So we're holding and owning US investments, but not hedging the currency to remove exposure to the currency. And then the US dollar just being the traditional S&P 500 if you are a US citizen. And we can see that in Canadian dollars, the S&P 500 has done significantly better than in US dollars over the last few years. So at North Road, we don't hedge out US exposure as far as US currency. We believe that there's some evidence in the historical record that this is valuable for Canadians to have exposure to the US dollar, or at least US assets in US dollars. And that has rewarded us the last few years. It won't always be the case, but we do believe that most of the time the historical record shows us that it's valuable to own multiple currencies, or at least US dollars. All right, Canadian versus US bonds. What we've done here is we've looked at short-term short-term government bonds, both Canadian and US, and we've made the currency the same. So we've made it US dollars. So think of the Canadian bond returns being converted to US dollars to make sure all we're looking at here is not currency, but rather how has US government bonds done versus Canadian government bonds. And we can see that Canadian government bonds have done quite a bit better than US government bonds over the last few years. If we looked at where government bonds are at right now, as far as the yield on those bonds, we would see that U.S. government bonds for the same time frame would have a higher yield on them than Canadian bonds would. And so we might expect that over the period of time moving forward for those bonds, what we call duration or maturity, we might expect actually moving forward that U.S. bonds might provide better returns outside of currency or maintaining currency as equal than Canadian bonds, because they have higher rates right now, higher yields right now. That's an indicator of what we expect future returns to look like. Of course, changes in interest rates change all of that. And so whether or not the Bank of Canada raises or lowers rates, and the same with Federal Reserve in the US, will affect our returns. REITs, so real estate income trusts, looking at real estate globally versus Canada, Canada in green, global in blue. And we can see that global real estate, global REITs, have outperformed Canadian REITs over the last many years. So if you're thinking about your real estate and how real estate is done, know that the diversification for global REITs in this case has been helpful over this time period. Last but not least, I want to look at gold. We started 2026 with lots of folks asking about gold. So I in our annual year in review that we did in January 2026, looking at 2025, one of the things we touched on was gold. Lots of clients last year were asking about gold. Gold prices were really rocketing, and clients were asking if they should own it. And in our review in early 2026, I said, a lot of the return, the really nice return we got from Canada last year, actually came from exposure to gold because we have gold miners. And I thought that was enough, was my recommendation. We're getting exposure. It'll be okay. And lo and behold, in 2026, we saw the opposite. We saw prices go up in the first couple of months, and then we've seen a dramatic reversal here in returns over the next few months. So we always have to be a little careful that we're not chasing returns when we're investors. If we see things that have gone up significantly in the recent past, sometimes they have these reversals or this mean reversion where we see prices come back down, and we have to be a little careful we don't get caught in those. All right, let's talk about where markets are at and why they're doing so well. We've had really phenomenal returns over the last 3 years in most equity markets. And one of the things I want to talk about right now is why are markets doing so well? Often when people start to talk about the idea of a bubble in markets, in equity markets in particular, we have this sort of underlying perception, I think, that it's because investors are acting irrationally, that it doesn't make sense. And one of the things I want to highlight to start with is that part of what drives stock prices is earnings in companies. Are they making more money? And I would say that one of the reasons that returns have been so good is that companies right now have learned how to make lots of money. And as owners of those companies, we should be really, really happy with that. So on the chart here, I'm showing earnings growth and earnings expectations for S&P 500. And thanks to our friends over at Wealth of Common Sense for this amazing chart. And you can see right here in the recent past, this enormous jump in earnings expectations for S&P 500 companies. So why have prices on stocks gone up so much? Well, investors have noticed that these companies are continuing to be incredibly profitable, at least as a group. I'm going to show you a few instances where some of these stocks have fallen significantly, but others have done really, really, really well. So as an index, as a group, the expectations for their earnings have risen and the stock prices have risen as a result. Investors are always trying to think about, is the company I'm holding now going to be a great investment into the future? And that's taking a look at cash flow and profit and bringing it back to today to decide if we should own it today at this price. And right now, investors are saying, yes, these companies are really successful. Here's what I would call an extreme example of this. So Micron is the chart I'm showing right here. And you can see this is in blue, the trailing 12-month earnings per share, and in pink, the expectation of their earnings moving forward. And the difference is enormous. So Micron's stock price has exploded in the last many months. And a part of that, for sure, is that its earnings expectations have also exploded upwards. And so the market is trying to look forward and say, if this company is going to make so much money, what is the right price for its stock? Why is it exploding in earnings? Well, AI. As we know, AI is changing the world, and it has already started. And we're at the very beginning of that change. And what we're seeing is that the data is saying that realized revenue from AI is growing faster than any tech revolution over the last 25 or so years. So in purple here, I would call it purple, maybe it's pinkish. Generative AI from 2023 is growing 3 times faster than the internet boom in 1995, as far as realized revenues from that, mobile apps, so post-iPhone mobile apps in 2007, cloud computing in 2010. And so as a result, if revenues can increase this dramatically, companies want to flood in and take advantage of that. And they're willing to spend money now in order to be a part of that. And we're seeing this build out in AI infrastructure to facilitate this massive growth in revenue. And that's funding a lot of the growth of companies like Micron. So here on this chart, we're showing capital expenditures by the major, what are called hyperscalers. This is Alphabet, Amazon, Meta, Microsoft, Oracle. These are the companies that are building out AI data centers and taking advantage and trying to build out AI infrastructure to take advantage of the growth that's happening in this area. And we can see that they went from pretty, sort of, I would call it average to even low capital expenditures on their balance sheets to dramatic increases between 2024 and 2025. Almost, I would say almost, because I can't do the math live, almost 100% increase in capital expenditures from these companies. Then in 25 to 26, the expected expenditures, again, almost 100% increase, leveling off slightly in 27, 28, but even still a dramatic increase in the spending that's happening on AI infrastructure. As a result, companies that provide semiconductors and chips and those types of things to this AI infrastructure are seeing enormous increases in sales and profitability as prices rise to try and take advantage of the fact that we're seeing shortages because folks weren't expecting this big a build out this quickly. All right. So we just explained why we're seeing great returns coming to stock owners and to stocks, and us as owners of those stocks. When will the good times end? That's probably one of the main questions that I'm getting from clients who are saying, listen, I've had most of the time in equity markets, double-digit returns for 3 years. When should I expect that that returns are going to decrease and or go negative? And the real answer is nobody knows. Back in, I believe, January of 2025, we were doing a year in review, and I said in that video, I believed we were at the beginning of a major bull market. And as investors, when bull markets happen, driven by technological change, we just have to grab the horns and ride the bull. And at some point, we're going to get bucked off, but we have to go for the ride. And at the same time, not get FOMO, not get the fear of missing out on things and take too much risk. So when will the good times end? I can't tell you that. No one can tell you that. If anything, we want to manage risk. But there are a few things in particular to be aware of that could be risks that will surface here in the future. So one of those things comes from the spending I just showed you. So this chart looks at operating cash flow. So cash flow coming into the hyperscalers, the companies I just showed you that were spending on capital expenditures. So the cash flow coming in, and it takes away the capital expenditures that they're spending and leaves us with what's called free cash flow. And we can see that even though cash flow in blue, operating cash flow has been rising pretty significantly, so they've been bringing in money, they've been doing a good job of generating sales. We also see that capital expenditures in green is growing even faster. And so even though we think of companies like Amazon, Alphabet, Google, Microsoft as being low capital expenditure software companies that provide software, services, those kind of things, we can actually see that they don't have cash flow right now. They actually have free cash flow dropping dramatically, almost to zero in 2026 is the expectation. So they're funding all of these expenditures on AI infrastructure from their cash flow, and it's creating for investors, many investors, a problem. People are becoming concerned because once the cash flow can't pay for the expenditures, we have to take on debt. And we're hearing more and more about taking on debt, or in Google's case, Alphabet's case, issuing equity and diluting equity. And so we have to be a little careful as investors as to what's going to happen here. If they can't drive more cash flow from all of these capital expenditures, then we start to get into potentially some problems. The second thing that could be a risk facing the AI build out is who will actually be the beneficiaries as far as companies of the AI build out and technological wave. Is it going to be the United States with companies like Anthropic and Claude, or is it going to be China with companies like Kimi and other DeepSeek and other models? And what we're seeing, this chart shows data from a company or an organization called Open Router that measures how much usage is being how much of these models are being used as a measurement of tokens. So rather than dollars, rather than revenue, it's the underlying compute that is being measured. And we can see on the right-hand side that recently in the last little while, Chinese models have surpassed US models as far as the actual compute being used. And why would this be? Well, quite honestly, the Chinese models are much cheaper than the US models. The data that I've seen and heard is that they are between 90% and 60% cheaper than the US models. So if you're a company using AI to build out your product or your service, which one do you want to use? You want to use the cheaper one because you're going to be able to use it more or expand your margins. And we're starting to see that now. Are the Chinese models the best? I would say almost no one would say yes to that, but they're pretty darn good. And for the price, they're very good. And so we're seeing that. One of the concerns we have at North Road is, are they secure? That is a bit of a side note. And obviously some companies and organizations and consumers feel that they're safe enough at the very least. Last but not least, I want to talk about inflation. So this is showing one version of inflation, what's called the PPI. And I've cherry-picked it to look at semiconductors and electronic components. So the things that go into the electronics that are running the modern world. And similar to that Micron chart I showed you earlier, which would contribute to this, it's exponential, I would say, in the last year as far as the change in the PPI and change of inflation. And so when and how will this trickle through to our electronics and our lives, and how do we start to adapt to inflation over the next little while? That's really the question mark and the uncertainty. And being an investor means sitting in uncertainty. We have to sit riding the bull, knowing that at some point it could be inflation, it could be Chinese dominance, it could be debt and by the hyperscalers. We don't know what it will be that will cause us to get bucked off, so to speak, but something will. And making sure that we're comfortable with the risk we're taking is the big takeaway. Last but not least, I want to mention that there are many, many, many companies that you think might benefit from the AI revolution whose stock prices are getting really, really hurt. One example that I have on screen here is Salesforce. Salesforce is a big client, a relationship management software company, very well known, used in many, many, many industries. And you would think as a software company, they might actually benefit because they can integrate AI and make a better experience for their clients or for analyzing their clients' data to help their clients sell more or drive up margins or do any of those things that folks might use AI for. But markets are saying, you know what, we're afraid AI is going to create less profitability in the future for Salesforce. Maybe it's going to drive down Salesforce's revenue, the amount they can charge. Maybe it's going to create competitors to Salesforce that are going to be cheaper, any of those things. And so many companies right now, even though the S&P 500, as an example, has done well, there are many companies inside of the S&P 500 that have not done well and have had a challenge. And this is the nature of investing. We have to be okay that nobody knows who the winners are going to be in a technological revolution like this. We have to sit in the uncertainty. And one of the best ways to do that, as we have said, is massive diversification. Yes, some of these companies are going to do poorly, but many of them are going to do very, very, very well, like Micron. And so we want to make sure that we're holding massive diversifications to make sure that we own the winners as well. All right. Should we stay optimistic? Well, I sort of hopefully give you a little bit of optimism there at the end as to why diversification is the right way to go and why it's helpful. I believe we need to stay optimistic, as you might guess from my riding the bull metaphor. Here's a little bit of data, and there's lots in this chart. So I'm going to highlight a couple things with my red dot. What this chart is trying to say is when we have had instances since 1950, this is the S&P 500, when we've had instances since 1950 where we had a quarter of negative returns, and then the quarter after that, we got double-digit positive returns, which has happened recently. What happens to the S&P 500 moving forward from there? And we can see that in almost all cases, the S&P 500 moving forward was positive in 1 and 2 quarters later. On average, 1 quarter later, it's up 6.8%, and 2 quarters later, it's up 10.6%. So optimism that even though we might get double-digit positive returns in a quarter doesn't mean we're going to have an immediate reversal from there. All right. So I think there's some optimism for sure. We got to ride the bull and we got to be okay with it. It's a perfect time right now for clients to review their goals and portfolio strategy report, what we call the GPS report. That's the foundational document, if you remember, around how your money is managed. It looks at risk. It looks at expected return. Go back and look at your risk metrics. Are you comfortable still with what risk metrics are there if markets took a downturn? Because at some point they will, and no one will see it coming. That's the nature of being an investor, that the real downturns come from surprises. We can't predict. That's why they're so shocking. And take a look and just make sure you're going to be comfortable-ish. It's never fun, but comfortable-ish if that happens. One of the caveats from this chart I want to highlight is in 1999, 2001, the dot-com boom and bust was the one moment in this chart when we saw negative returns. So obviously I'm talking about AI and the AI revolution, and there's lots of corollaries there between the AI revolution and the dot-com boom. And so could this be the instance here outside of the dot-com boom and bust where we might see a downturn where in the coming quarters it doesn't match this pattern that we're showing on screen where we get positive returns? It's definitely possible. At the same time, this is a very different situation than the dot-com boom and bust. We have very profitable companies, great companies that are spending a lot of money to build out the AI infrastructure. That can be a challenge, but at the same time, they're still very, very, very good companies, even if they needed to change their business models. So all of that to say, we got to keep riding the bull, stay invested, manage your risk, stay away from FOMO. If you came to me now and said, should I borrow to invest? I would say that's probably a bad idea. But as always, come and talk to your advisor, get individualized advice based on your unique situation. And with that, I'm going to call it an end to today's update. If you have questions, please reach out to us. If you need a review, please reach out to us. You don't often see me solo. Send me a note. Let me know how I did, and let us know if there's any way we can help you whatsoever. Last but not least, more events coming this fall, more changes coming to our website, continuing to try to improve for our clients. So keep an eye on your email. Give us a call if you have any questions, and look forward to seeing you soon.